Thanks, Cathaoirleach, and I'm glad of the opportunity to make some brief comments on the Finance Bill 2017. Of course, one of the 57 sections in the bill which attracted much comment among our constituents is Section 54, which makes change to the Tax Consolidation Act 1997, the VAT Consolidation Act 2010 and the Stamp Duties Consolidation Act 1999. And of course, the section refers to penalties for deliberately or carelessly making incorrect returns and defines offshore matters to include relevant accounts, income and gains, relevant property situated, and the other income, gains, accounts or assets arising or held in a country or territory other than this state. The amendments to the Principal Act, of course, withdraw from May 1st, 2017 the penalty mitigation arrangements currently available to tax defaulters holding accounts and assets offshore. Now, the chairperson of the Revenue Commissioners, Mr Niall Cody, has indicated in a recent interview with the Sunday Business Post that the practice of people mitigating penalties and avoiding criminal prosecutions by making voluntary disclosures on untaxed income when tax evasion has taken place is finally being brought to an end. But of course, commitments like this have been made again and again over recent decades, and yet we find tax scandals like those revealed in the LuxLeaks scandal and the Panama Papers revelations. They continue to enrage compliant taxpayers in Ireland and all our citizens, and indeed right throughout the OECD. Indeed, Cathaoirleach, the sums involved in offshore tax evasion continue to be vast, and the Revenue Commissioners report that almost £3 billion in additional tax interest and penalties have been recovered for the state from Revenue's investigations into offshore evasion. But several commentators, including the distinguished Sunday Independent journalist Mr Jean Kerrigan, have rightly queried the whole rationale for so-called penalty mitigation arrangements for tax defaulters referred to in Section 54. There were never such arrangements, Cathaoirleach, as you know, for PAYE workers and compliant small business and farming and the compliant self-employed. PAYE workers in particular have no choice but to meet their income tax obligations in real time over the last 6 decades since the PAYE system began. So therefore, is there one law and one finance bill for the people who control this country, who run this country in Parliament, and another for the mass of hard-working families and individuals? A reading of this bill and many of its provisions would perhaps feel that it is the people who own this country who do eventually write our finance bills. And why, Cathaoirleach, why May 1st, 2017? Why are the super wealthy allowed another future deadline to get their tax liabilities in order, or indeed to move assets and accounts through further Finance Act loopholes into more on tax havens? I put questions like this to the first Finance Minister I spoke to across the floor of this House, former Minister in Taoiseach Bertie Ahern. He sanctioned, of course, a second tax amnesty in the early 1990s, which was supposed to bring all tax due on tax evaded and offshore assets back to our exchequer. But of course, vast sums continued to be placed outside the remit of our Revenue Commissioners as financialisation of assets grew exponentially down to the crash of 2008. Now, 8 years later, Part 6 of the bill is trying to close the stable door once again. Hopefully, Section 55 on changes to the publication of the names of tax defaulters will act to throw further light on defaulters who have failed to pay a settlement sum. But our constituents rightly ask why the amendments in Section 54 don't at least commence from the passage of this finance bill through the Oireachtas. There were lengthy discussions, Cathaoirleach, at the Dáil Budgetary Oversight Committee, of which I am a member, about the avoidance of massive amounts of corporation tax by the misuse of Section 110 of the Taxes Consolidation Act 1997. Using the device, of course, of a profit participating note, the PPNs, vulture funds, often based in a foreign law tax jurisdiction, lent their Irish subsidiaries funds to buy bad loans on property in Ireland. The profit participating notes, of course, were repaid from revenue before tax, thus almost eliminating all Irish tax owed by the Irish subsidiary vulture funds. Hopefully, Section 21 will now begin to address this Section 110 scam, which has cost the Irish tax exchequer so dearly. Section 21 lays down that the coupon and profit participating notes will not be deductible in calculating the profits of the specified property business unless the PPN is paid to an individual or company paying corporation tax, an Irish or EEA pension fund, and an EEA citizen or company who will pay tax on receipt of the interest, provided that the payment of the coupon to the EEA citizen or company is not for tax avoidance purposes. I also welcome Section 21AI, which reduces the period within which a company intending to use Section 110 of the 97 Act must inform Revenue within 8 weeks of acquiring qualifying assets of €10 million. There has also been a widespread welcome for Section 22, which inserts a new Chapter 1B to Part 27 of the Taxes Consolidation Act 1997. The new chapter, of course, provides that Irish real estate funds, the IRFs, must deduct a 20% withholding tax on certain property distributions to beneficiaries who are not within the charge of Irish law out of profits arising from the fund's Irish lands, although certain categories of investors, such as pension funds, life assurance companies and other collective investment undertakings, are excluded. Now, Section 22 seems to apply to all funds currently in the Irish property market, and if so, this is a positive step by the Government. Perhaps the Minister would clarify in his response that Section 22 is indeed retrospective in terms of the companies, in terms of existing vulture funds. Hopefully, economists like David McWilliams, who have been critical of vulture funds' virtual tax-free status, are correct when they predict that the introduction of this withholding tax will lead to a fall in the price of commercial property in Ireland and a resulting fall in the soaring rents and costs. I note that Irish real estate funds, IRFs, are defined as investment vehicles where 25% of the value of the vehicle is composed of Irish real estate assets. Have the Minister on Revenue any estimate of the losses to the Exchequer by the lack of a withholding tax over the past 6 or 7 years, and the likely tax amounts which will accrue to the state from the new tax in 2017? Has he any similar information on the widespread misuse of Section 110 of the 1997 Act? The question must be asked again, however, why the Minister did not move, as he said in last night's speech, to, and I quote, ensure that the Irish tax base is appropriately protected, end quote, in his earlier budgets. It's, after all, is it his 7th budget, this budget we've recently had. He might also tell us how he will ensure that this Section 110 regime is maintained for bona fide securitisations, as he terms them in his speech. I welcome, of course, that Section 21, amending Section 110, applies to profits arising from the holding of financial assets based on Irish land and property in the account period from September 6, 2016, and doesn't permit the Section 110 companies to revalue or mark-to-market their assets at that date. And on the issues of Section 110 and the withholding tax and the performance of vulture funds generally, I'd like to commend a number of our colleagues in this House, Cathaoirleach, who have done outstanding work in investigating this matter, and in particular I think Deputies Stephen Donnelly, Deputy Pearse Doherty and Deputy Richard Boyd Barrett, who brought some of these issues before the House repeatedly. One of the biggest responses, of course, by constituents has been to Section 8 of the bill, which inserts into the Tax Consolidation Act 97 the provision of an income tax rebate which will be available to first-time purchasers of newly built homes. On the 19th of July, of course, 2016, our Minister for Housing, Deputy Simon Coveney, launched Rebuilding Ireland, the Government's updated action plan on housing and homelessness. At the time, he spoke of assistance for first-time buyers and the deposits needed, given the extortionate rents being charged, particularly in our cities. On Budget Day, the details were announced, that, of course, that a rebate of 5% of the property value, a tax rebate of 5% of the property value up to a maximum of $20,000 will be paid as an income tax rebate on income tax paid over the previous 4 years, and it would apply only to new bills and self-bills, and up to a maximum of €600,000. And a mortgage of at least 80% was at the time required for eligibility, which of course was introduced to 70% as the Central Bank was concerned the first-time buyers would take on too much debt. But, Minister, when the mortgages are limited at a 3.5 times LTI ratio, surely this now means that the rebate to be given has just been largely negated by the need to have a higher level of deposit. It doesn't seem to make sense. In 2015, of course, of the 38,000 new houses sold, just 760 were purchased by first-time buyers. And it has to be said also, a number of my young constituents and young families, they have bought new homes in the past 3 to 6 months, Cathaoirleach, in DBN and Dublin Bay North. The building out of our north and south fringe estates in Dublin City and Fingal has finally recommenced in the past year. Thankfully, much-needed homes are at last being supplied by developers in the region, and hard-pressed young families and individuals have desperately managed to cobble together a deposit and move into their new homes in recent months. But they'll derive no benefit from Section 8 and have fairly asked that the tax rebate should apply to all taxpayers who bought their first home in the 2016 tax year. And it's perhaps something, given the depths of the housing crisis, the Minister might look at. Many housing advocates and agencies, of course, have queried the impact of the demand-side Section 8 instrument and whether it will simply result in even higher prices for the still very limited supply of new homes in the Dublin region and our other urban areas. Just 75 new social housing units were actually built in 2015 and only 117 new builds social new builds have been constructed by local authorities in the first half of 2016. Indeed, the vast majority of the 13,000 social housing units which were delivered in 2015 were brought forward through the HAP scheme, the Housing Assistance Scheme, and the private rented market. Section 8 is therefore very unlikely to ease the appalling levels of homelessness and rack renting in the Irish housing market. The last available figures from the end of August this year show that there were 4,248 homeless adults across the country, with 2,950 of these in Dublin. At that time, there were also 1,151 families in homeless accommodation across the country, with 2,163 children. 988, almost 1,000 of those families, Cathaoirleach, and 2,012 of these children are homeless in Dublin, including a large number from my constituency. And of course then we have the hidden homeless that the Cathaoirleach would know about so well. On one October night recently, Cathaoirleach, 169 people were engaged with Dublin's Housing First service, and RT's Prime Time has estimated the numbers on waiting lists for social housing nationally jumped 2% in the last four months, from 135,832 to 139,359, an increase of 3,500. Our DCC, Dublin City Council housing list, hit a new peak recently when 44,000 people were waiting to be rehoused, and there were 9,522 families and individuals waiting for social housing for between 5 and 10 years. The inevitable corollary, of course, to these appalling housing list figures is the shocking situation outlined by DAFT last August, which shows that the average monthly rent nationwide is at its highest level on record, with rents rising almost 4% in the second quarter of 2016. In Dublin, the annual rate of rent inflation was 11.1%, and rents in the capital are now 5.2% higher than their previous peak in early 2008. So the litany of these awful housing figures and the housing needs of our constituents, our people, will not be remotely addressed, Cathaoirleach, by Section 8 of this bill, or the other inducements for landlords, which I refer briefly below. Rebuilding Ireland and the earlier housing plans brought forward when Minister Noonan has held the finance portfolio are simply a totally feeble response to a desperate crisis. The deeply ideological position taken by Ministers Noonan and Coveney of the complete reliance through HAP and other finance bill measures in the private sector has caused profound suffering for tens of thousands of Irish citizens and their children. And of course it is the fact that the hard right have been in charge of our government for the last 6 years, which has created and exacerbated a desperate situation. Cathaoirleach will know even in 2011 we had a housing crisis, and now we have a worse one. But it's clear that Governor Philip Lane of the Central Bank, in letters to our colleagues in this House, is extremely dubious of the efficacy of a demand-side measure like Section 8. Governor Lane seems to rightly feel that only a greater level of construction of new homes can restore the totally dysfunctional Irish housing market. As I remarked several times at the Budgetary Oversight Committee, Governor Lane himself and his predecessor Patrick Honohan have to take a lot of the blame for the current housing impasse. Their macro-prudential rules are singularly unhelpful to first-time buyers. Hard-working two-income young couples inform me that they pay rents of perhaps at least €1,300 to €1,500 a month plus, and could just as well be paying a mortgage. But because of Philip Lane's macro-prudential rules, they just can't get a deposit together for most areas of Dublin Bay North constituency. So hopefully Section 8 will offer some hope to these families, but a fundamental revision of the Central Bank macro-prudential rules must result from the review to be announced next month. And of course we look forward to discussing that in this House and indeed at the Budgetary Oversight Committee. Many constituents, of course, have asked whether additional tax expenditures should be incurred through support for landlords. And indeed, at the Budget Committee, Cathaoirleach, I've repeatedly raised the whole issue of tax expenditures. And indeed, when you look through this budget, there's a whole list of those expenditures, sections 14, 15, 16, 17, and so on, which this House is not given any costing on. We get a kind of a vague costing in parts of the budget on some of them, but the actual basic figures to be able to frame and shape a budget, particularly in terms of tax expenditures, are not available to us. And I think anybody coming in here with a section to spend taxpayers' money or not collect taxpayers' money should come in here with the cost, with a fairly precise costing of the expenditure that's going to result. And that's not the case at the moment. So while Section 12, amending Section 216A of the 97 Act, expands exemption from income tax from €12,000 to €14,000 for 2017 for people letting a room in their private residence, many assert in providing may assist rather in providing much-needed accommodation for students and single people. Other new reliefs are more questionable. For example, the Section 15 provides a full interest deductibility in respect of rented residential property in the 1997 Act to be restored over a 5-year period by means of 5% annual increments, with 75 to 80% applying to interest accruing after January 1, 2017. Likewise, outside the Fine Gael party, many citizens have asked why the threshold A is being increased from €280,000 to €310,000 for gifts and inheritance taken after October 12, 2016. It's no wonder that many of the 700,000 citizens who rent and have to rent a home may clearly conclude that Minister Noonan and the Fine Gael party, Cathaoirleach, care only for the rights of landlords and property owners, as exemplified by Budget 2017 and the Finance Bill before us. So I believe Ministers... Thanks, Cathaoirleach. Yeah. Ministers Noonan and Coveney, they could have used this budget and finance bill to gear up the local authorities in terms of planning and construction staff, expanding it, going back to the era that the Cathaoirleach will remember in the 80s and before that, when we were building very fine estates for the very most part across the city and across other cities in the country, and would finance, of course, local authorities in terms of CPOs to take the land to build large social, multi-agency tenure and affordable houses and apartments for our constituents. They chose not to do so, of course, and they'll be judged on this matter in the general election. Just in the remaining few minutes I have, Cathaoirleach, I'd also...
13 and a half left.
13 and a half left. Just before I pass over to my colleague, I'd just like to raise the issue that a number of constituents have brought to our attention about Section 86 of the Capital Acquisitions Tax Consolidation Act, which allows parents to gift properties to their children without paying tax once the child has lived in the property for 3 years, and I think goes on to live there for another 6 years. It's said, and the distinguished journalist Mr Ken Fox has done outstanding work on this, it's said that the tax loss from this tax expenditure is something of the order of €120 million a year. In other words, for certain very rich people who can buy houses for $1 million plus for their children and gift them, that inheritance tax doesn't simply arise. So I'd like to know, is this the case? And a number of our constituents have taken Mr Fox's articles, brought them to our attention. Is that the case? And what are we going to do about it? And what can we do about it at the committee stage?
Thanks,
Cathaoirleach.